Hey, it's Soleil, and this is episode 11 of Red Pilled Orange Pill Investor. And Bitcoin ETFs were approved, and Bitcoin didn't do a whole lot, but I guess maybe people were moving a bunch of money from their mining stocks and their other Bitcoin stocks to these ETFs or something, because generally Bitcoin doesn't move, moves along with the mining stocks and MicroStrategy. Well, it's the other way around. Those stocks tend to move with Bitcoin, but Bitcoin really didn't, it didn't pump too crazy. What? Not even 1%. Like 45, 46, went up 2 or 3 grand, and then went right back to where it was. So slight pump on the news. However, I got wrecked pretty bad on MicroStrategy. I mean, it's up in general, but over the past week, down 13%. So my value got wrecked, but with the way that I kind of look at it, it doesn't really bother me that much. And the reason why is, why would you even invest in the stock market at all? So I think your basic assumption would have to be that you think that the stock market will continue to go up as it has gone up for the past, it's been 100 years. It crashes sometimes, but in general, it's just, the overall trend is up and to the right. So if that's your basic assumption, that kind of needs to be your basic assumption. Otherwise, why are you trading? So doesn't really matter if things are temporarily up or down. What matters is that I'm continually adding shares. So I was able to pick up some cheap shares in MicroStrategy, and I went ahead, and since there was precious little premium left in those calls, I mean, they were worth like $1,500 to $2,000 or something when I sold them, and there was only like $15 left in them. So I went ahead and just rolled them a day early to next Friday. I usually just do it on Friday out of convenience, but there was no point in letting them go until tomorrow just to get another 15 cents, times 100. Some of the other stocks like Riot and Mara, I didn't do. I'm going to wait until tomorrow to collect every last little bit of those. But yeah, you kind of, your assumption could be wrong. The stock market could blow up and never recover. But that's my basic assumption, to even feel like I should be in the stock market at all. If I don't think it's going up, then why am I here? I mean, unless I'm smart enough to short it, and I'm not really up on that strategy, so that's not one that I employ. But I did have a request to go over some of the basics, and there are probably better teaching videos out there. However, you got 4 options when you're trading options, and everything is in multiples of 100. So if we're buying this call for 26 cents, you're really paying $26. And if the share price is $13.13, and you're buying 100 shares, in order to trade options, or covered calls at least, this is going to cost you $1,313. So let's just take a look at each of the 4. I'm only really doing covered calls, so I'm only selling calls after buying 100 shares right now. However, I have sold puts, and that combination of selling puts and selling covered calls alternately is called the wheel strategy. Maybe I'll touch on that just briefly. But just starting from left to right here, if you're buying a call, that means you are paying this price times 100 for the right, but not the obligation, to purchase 100 shares from the person on the other end of the contract for this agreed upon strike price. So if you buy a $14 call for this Friday, which is tomorrow, for 14 cents, which means $14, then you can force that person to sell you 100 shares at 14 a pop. Now, the only reason that you would do this is because you think the price is going to not only go over $14, but it has to go over $14.14 in order for it to make up for you having paid this $14 up front in the first place. So that's what buying a call means. And generally, this is considered a long position, because the person who's doing this is basically scratching a lottery ticket and saying, I think the price of this stock will go above $14, so far above $14 that it will make sense to pay 14 cents a share for 100 shares. If you choose a different strike, you're only paying $7, but the price would have to go all the way up to $15.07. It would have to go over that price in order for you to quote unquote win this trade. Most of calls that people buy expire worthless. So if the price doesn't go over, if you buy the 14 or you buy the 15, if the price doesn't go above those by the end of trading on Friday, then it expires worthless and nothing happens, except the person that you paid gets to keep your money that you paid them. So that's why I am a seller and I sell calls. Now, the only way that you can sell a call without generating infinite risk, some exchanges will let you sell calls without actually owning the stock, but that's pretty risky, and the reason is because it introduces infinite risk. So if you sell the $14 call for 14 cents, you get paid, and the price of Riot goes up to $30 a share. Now you've got to sell you've got to sell 100 shares that you don't have for $14 a share to the person on the other end of the contract, which means you've got to go out to the market and pay $30 a share for Riot. You're going to pay $3,000. Then you're only going to get $1,400 from this guy, and he's only going to pay you $1,400 for those shares, and the other $1,600 is all going to come out of your pocket. So the reason why they call it infinite risk is because if Riot went up to 1 million or infinite millions, you would owe however much that is. I think it's called selling naked, and some of these institutions that have bottomless pits of money, maybe they do this, or just people who are degenerate gamblers. But it's pretty safe bet to go ahead and just buy the shares. That way, if you kind of get screwed and the price goes to 30, you don't have to go out to the market and pay $30 a share. You probably bought them for $13.13, so you really don't care. you got to sell them to this guy at 14, so you made $87 profit plus the $14 that he paid you, so you made $100. You're happy, and he's happy because the price went to 30, and he only had to pay 14 for them, so he's happier than you, but you know, you can still be happy. And that's another reason why I love selling covered calls, is because it's one of the only trades that's not a zero-sum game. Both persons on each side of the trade can actually win. So if your 100 shares get called away, let's say the $15 strike, you're going to make $187 plus the 7. You're going to make $194. And you spent $1,300 to make 100 and what did I say, 180, 190. So that's like, I mean, that's 10-15% in 1 week. You can't be mad about that just because the other guy paid $7 and made 200, and you know what I mean? Like, he made more in a percentage than you did, but both parties profited. So even from a moral perspective, to me, this is the most I don't know, fair outcome where both, it can be a win-win scenario for both. So there's the buy call, which gives you the right but not the ability to purchase the shares at the strike price. There's the other side of that where you sell a call, which gives the other person the right but not the obligation to purchase shares from you at the strike price. And then puts are kind of opposites. So I might as well just start with buying a put. But buying a put is the opposite of buying a call. So this is going to give you the right but not the obligation to force them to buy your shares at that price. So in this case, you think the price is going down. And I'm not even going to talk about it anymore because it gets confusing, and it's not a strategy that I think I ever really even do. So let's just define it and move on. But then there's selling puts, which I absolutely do, or have done. I really just skip this step at this point and buy the shares and go straight to the covered call. But it's pretty similar as far as potential profit is concerned. So selling a put gives the other person the right but not the obligation to force you to buy their shares. And this is still not a bad deal. Like, I'm just going to go out to next week to make this point a little bit better. So generally when I'm selling covered calls, I'm picking something over the strike price. And when you're selling a put, you're generally going to pick something under the strike price. So really what you're saying is, if I sell the 13, the other guy's going to pay me $80, and he's thinking that the price of the stock will go down, let's just say maybe to 10, and he's going to force you to buy his 100 shares for $13 instead of the $10 that they're worth. And so then you get stuck did I even say this right? Yeah, if you sell, yeah, he's hoping it goes to 10 so that you can buy them for 13. What you're hoping is, to an extent, you're hoping that the price stays above this so that this just expires worthless and you don't have to buy his shares. You know, you don't get stuck paying $13 for $10 stock. But you would do this in the event that you actually like the stock. So if I didn't mind paying $13 for this, I can actually take a chance and maybe even get a better deal by selling a put here, getting paid 80. So even if the price does go down to 10, I've reduced my cost basis by $80 because I got paid for the privilege of purchasing this stock in the first place. And even though that sounds bad, like, oh, the price went to 10, if you just buy the shares for 13, the price can still go to 10. The price can go to 1. The price can go to 0. So all you're really doing is choosing, like, oh, maybe that's not a good enough deal. Maybe you think that you don't want to own Riot unless you can get at least under $12. So the other option that you could do is you could put in a limit order and you could say, I'll buy 100 shares of Riot at 12. Well, what if the price never goes down to 12? Then you're literally just doing nothing. Your $1,200 is sitting in this account, and it's not becoming more. It's not getting greater value. The price of Riot may never go below 12 ever again, and you're just wasting your time by saying, I'll buy Riot at 12 if it never goes to 12. However, if you sell a put at the 12 strike and the price never goes down to 12, it's still true that you're never going to buy 100 shares of this stock because this is never going to kick in. However, you did get paid $37. So instead of having just $1,200 sitting in your account doing nothing, now you've got $1,237. So selling premium, the price over here, this is called premium. What you get paid is premium. So buying options usually does not work. They usually expire worthless, but you can hit the lottery sometimes. I don't really do lottery. So what I do is a little bit more reliable. I'm a premium seller. I would prefer to sit on the other end of the trade and let their contracts expire worthless and let them just pay me. All right. So those are the 4 basic choices that you can do. You can buy a call, sell a call. You can buy a put, sell a put. For the purposes of my strategy, which is not like I invented it or anything, I just sell covered calls, and then I use that premium that I got paid to buy more shares. And then once I have another 100, I sell another covered call against it, and I buy more shares, and that just continues on forever and ever and ever. So let me just go over the basics a little bit easier, or, a little bit more in depth, I suppose. So let's say you bought your 100 shares for $13.13 times 100, which is $1,313. And we're going to go not till just tomorrow, but just to get a full week's premium, full 8 days. You have to decide which of these strikes to pick. And if you want to be extremely greedy with the premium, you can just go right at the money, the one that's just above the strike price. I don't generally prefer that unless I've just, maybe the first week after I buy 100 shares, just to get the most premium out of it and reduce my cost basis the most. So in this scenario, I paid the $1,300. I get paid $71, so that reduces my cost basis to 12 something. And I would then immediately buy, what can you buy, like five more shares here. Or if you sell the $14 strike, you'll get paid $56. and you can buy four shares with that. If you sell the $15 strike, you get paid $34, and you could buy an extra 2, almost 3 shares of Riot extra. The trade-off is that if the stock price does pump on Riot, you would either be forced to sell off your shares at this price, or you would be forced to buy back the contract and really come out of your own pocket in order to retain your 100 shares. Otherwise, you'd have to go back to the market, buy those 100 shares again. Not sure what kind of tax consequences that would have. But generally, I know a lot of people stick around the 0.3-ish delta. So some folks recommend approximately a 0.3 delta. This is about a 30% chance that the stock will go above this strike by this date. So about 2/3 of the time, you'll just collect this fee and it won't go above here. But about 1/3 of the time, the equation is predicting that it will go above this strike, and instead of this expiring worthless, you would have to buy it back or just sell off your shares for 14.5. So that's what I do. I generally, but anything in between, 0.38 is fine, 0.3 is fine, 0.25 is fine. I try not to go below 1% premium, so I wouldn't go past like this $18 strike. I mean, this would be extremely conservative, but if you just wanted to make sure that you almost never have to deal with the price of the stock going above your strike, then you could go way up here. There's nothing wrong with that. And technically, there's nothing wrong with choosing this 13.5. But halfway between 13.5 and 18, what is that? 4.5, so $2 up. Yeah, right around 15. 14.5, 15 is generally where is kind of the sweet spot for me. And I said it in the other video, but if the stock is down, I do get annoyed when I'll pick a low strike and then the stock rebounds back up. That can be a little bit annoying. So after the stock drops, I may get a little less greedy and I might pick a 15 or a 16. And if the stock price pumps, I may think, okay, the price is pumped as far as it's going to go, and I'm willing to be a little bit greedy and try to generate more premium and sell a little bit closer to the underlying share price. So to put the steps in the simplest terms, step 1, buy 100 shares of stock. Step 2, go to the next expiration date, or maybe one after. Choose a strike price that's above the share price, relative, probably close to a 0.3 delta, but that's not. There's no law that says you can't go above or below it, but that's kind of just a good starting place. Sell it, get paid the premium, and then however much money you have left over now, you buy that many shares of Riot. So in this case, that would be about 3 shares. So you buy 3 shares this week, and then depending on how things work out, you'll probably buy this back for a penny next Friday. Sell it again for another 43, buy another 3 shares, and then after, 33 weeks, you've got 200 shares. I mean, you can put more of your own money in if you want to speed up the process. But even just putting money in one time, you can operate this strategy. Maybe I'll talk about the Greeks just barely. So the delta, even though I said people focus around the 0.3 delta, what this really means is this is the amount that the contract price will go up or down based on $1 change in the share price. Gamma isn't terribly important, but theta is the amount that this premium drops per day. So it's going to drop by about 5 cents a day, and there's 8 trading days, so it's about 40 cents. So that's why most of these expire worthless. By my next Friday, theta will have eroded all of the value of this premium. Vega has some applications, but I'd have to go back and try to find that video. Some is a little bit over my head. So is Rho. But the bid-ask spread, that's enough for the Greeks, I think, for now. I'll link some other videos that are much more detailed about all of these, and probably better teachers too. So the bid is what people are offering, and the ask is what people are requesting. So there's people out there saying that they would like to buy this call at 14.5, and they're willing to pay 42 cents. And the sellers are like, yeah, but I want 44 cents. So the bid-ask spread is 2 cents, which is the difference between the two. And in order for a sale to be made, someone either has to go, a seller has to go down to the bidder's price, or the bidder has to go up to the seller's price, or maybe you put in one for the mark price, which is the average, and then at that point that might entice, if you say, okay, I'll sell it to you for 43, that might entice the bidder to come up and agree in the middle. And I think most of the time you're probably just trading with bots anyway. I don't even know how many real people are on the other side of these trades, but it's been so long since I looked at these, but I think volume is how many contracts exist, and then open interest are how many bids and asks are out there unfilled, possible. All right, so that's the basics. I mean, I can look at another one, but it's all the same. Buy 100 shares of Mara for $22,236. Come up here. Okay, that's 0.4, 0.36. You just want to go by the book. Here's the $26 strike. You could sell the $26 strike. This gives the other party the right, but not the obligation, to buy your shares for $26. So if the price goes to 27, price goes to 28, price goes to 29 or higher, they're going to be like, yes, that's a great deal. We want to buy these shares for 26 and turn around and sell them for 3,000 and make $400. That's what they're going to do. That's what they're hoping is going to happen. So you could just sell the 26 strike, get paid $91. You could afford another 4 shares of Mara. So you can buy 4 shares. Now you're the proud owner of 104 shares. And you just keep repeating that process until you have 200 shares of Mara, and then you do it twice. And instead of buying 4 shares, you buy 8 shares, and then you just keep doing that forever. So, at the risk of repeating myself, you buy 100 shares, you sell the covered call at a reasonable strike price above, above the current share price, and you use the additional money that the other person paid you to buy more shares, and you continue to do that until you have enough shares to sell an additional covered call, and then you buy even more shares, and then you keep going forever and ever. All right, y'all. I think that's good for now. Be good.